Good morning. I'm Johnny Goodwin, the least known. Half an hour with 4 of the world's leading investors upstairs and a couple of French guys on bicycles has put me in a very optimistic mood about where the world is compared to what I was preparing for yesterday, looking at the IPO market and the share price performance of some of the recent IPOs that we've seen. We spent half an hour talking about the world and what these guys are up to. And I think it's much longer term, it's much more positive than any of us would expect. So with that, I'm going to ask all of them to introduce themselves really by just talking about where their focus is in terms of investing in sort of social, local and mobile. And to add to that, they are all world-class investors. But what was the one deal over the last year that they regret not doing and why? Harry.
Great. So Harry Nelis with Accel Partners, part of their London office. Focus in mobile has been primarily on games. So we've invested in Rovio, Flare Games, and Supercell, all mobile games companies. In social, of course, we were the first investor in Facebook, but thereafter have done Playfish, Spotify, Branchout, local Groupon, of course, followed by other businesses such as Hotels Tonight, kind of a late, last-minute kind of booking site. In addition to that, very focused on next-generation e-commerce, where we invested in ModCloth, Stylus Pick, a subscription e-commerce business, as well as payments and financial services.
And is there a geographic focus, do you think, at the moment when you're looking at these subsectors? Is there an emphasis and a weight in terms of where the capital of Accel is going?
No, it's just where we can find the best deal, we do the deal.
Dave.
So this is the intro and what we missed, all of our fuck-ups for the year. Let's see, I run a small startup fund called 500 Startups. We do mostly very tiny incubator and seed investments around 50K. We're probably one of the most active investors. I think we've done over 120 deals in the last 12 months. Biggest miss? Yeah, I guess probably Parse. There's a company out of Y Combinator that's doing mobile infrastructure, and except because I didn't respond to an email quickly enough, I fucked up and missed that deal. So yeah, dealing with volume is one of my biggest problems.
Jeff Clavier, managing partner of SoftTech VC. It's a fund that I started 7 years ago, now doing about 20 investments a year, roughly 400K average, and we invest mostly in the US, 112 deals total, 2 in Europe. In social, local, mobile, so for us, social and local are kind of part of the fabric of infrastructure, so we spend a lot of time on the mobile side. Done a lot in mobile services, looking at next generation e-commerce. Yesterday we announced that one of our investments from 6 months ago, Fab, had raised a cool $40 million from Anderson Horowitz. Pretty excited about that. And also doing a lot of vertical SaaS. In terms of what we missed, took me 5 minutes to figure out which one I would sort of mention, but I would say Codecademy were the first term sheet on the company a few months ago, and then the $500,000 or $750K round became a $2.5 million round at a price that we couldn't swallow.
Fantastic. Harry.
Archambeau, Wellington Partners. We do invest in early stage companies throughout Europe, so mostly Germany, Scandinavia, UK, and still looking for a good French deal. We have been involved in this, mobile, local companies for a while. I think what we see right now is an angle that has not been the focus on the media very much. Is really the value that these new technologies are bringing to the actual business users, as opposed to on the small business users, as opposed to the end users. And there's a lot of value being unlocked right now in a lot of companies. So that's the type of theme that we're looking for. So we invested in companies like Quip, that has 20 million users as end users, but they have a couple of million of small business users. That's very interesting. So we're an early stage investor in Spotify. We're an investor in a small company moving very fast in London right now called Halo, that is also building a community not only of end users but of taxi drivers. Yeah. So it's very interesting. In terms of what we've missed, I think we'll know in a couple of years what we have missed. It's very difficult to know ahead of time. I think there's one company we wish we had invested in, and we literally came at their doorstep the day they were signing with someone else, that's SoundCloud in Berlin. Yeah. Great company.
And with your sort of slightly sort of European folks over here, are you worried about the debt crisis that's around us? Are you worried about the continued underperformance of the IPO markets for European internet companies compared to the pipeline that exists with more strength in the US? And we talked earlier about having a longer-term attitude. Is that...
Yeah, I mean, you have to be worried about the world collapsing under your feet if you want to continue to do business as, in some form of as usual. But there is resilience in everything that people do. So I think any type of debt crisis will have an impact for a short period of time. But what we do is really long term. And there is a couple of studies on the entire universe of venture deals that have been done in the past 30 years. And on average, it takes 9 years for a great company to go from first round of funding to IPO. And for us, venture capitalists who are making money on selling our shares either on public markets or selling our shares to a corporate partners buying the company, the average time for a decent return exit is 6 years between the early stage investment and the exit. So when you look at that, all the trends we're talking about today, did not really exist the way we know it 3-4 years ago. So there's a little bit of a disconnect between the expectation maybe of some investors and the reality of how long it takes to do that. The good news is, it takes time, so we are not focused on the really short-term issues.
Yeah, and I think we've seen that across the M&A markets as well. A lot of the M&A has been actually fueled by growth equity buyers outbidding what could be a potential IPO or indeed a trade sale. I mean, Harry, Jeff, you've seen a lot of capital on both sides of the Atlantic. Is it your belief that capital is there to stay and there is still a lot of capital fueling the long-term development of these types of companies?
Sure, I think that sometimes in the valley where we operate, we feel that we're in a bit of a parallel universe where the fact that the world is going to not a great place in terms of macroeconomics doesn't seem to impact the rush into early stage venture that we see today in the valley, and that certainly increases the valuations, that puts a lot of strain on the hiring market. And you wonder at what point the fact that the macroeconomics are really sort of pretty bad will impact us. But in the short term, we haven't seen any changes.
Yeah, I agree. I think the flow of money into early stage venture will continue to be there. What is key, though, is that we now see a decent exit market. And my hope is that here in Europe, at least, and in the US, at some point we get our act together, that the equity markets, the public equity markets will improve, that we get a decent IPO market again with a few well-performing IPOs, which will attract more investors, more public market investors to the table, so that more interesting companies go public, and there's this self-reinforcing mechanism that will then kick into place that will give us a good exit market, because that's ultimately how we make our money, how our investors make our money, and how the money flows back into the system.
In general, like most of the impacts on what's happening in the public market, aside from the exits and going public, like macro crisis, even the ones in 2008, have more impact on the LP environment, investments in venture capital, not so much venture capital investments in startups. So in 2008, what happened was dramatic pullback by the investors in venture capital funds, and that's still happening to some extent. And you possibly could see that again here. But I think really overall changes, structural changes in the venture capital market are much more dramatic and much more impactful than just liquidity crisis in one region of the world. I think the general trend towards a few very large funds that are acting more like late-stage mezzanine investors, and a lot of smaller funds like Jeff's and mine, and others, as well as incubator models. Those are much more the trend. I think a lot of venture capitalists are finding their models are squeezed between, are you in the top 10 branded entities that do the biggest deals, or are you very nimble in doing smaller and early stage deals? There's less impact from overall public market actions, aside from, hey, if Facebook goes public, then yeah, lots more people will be investing.
A couple of data points. One is, over the past 3 years, US venture has invested more than it has raised. So at some point, we can see a potential shrinkage of the our market. And then over the past 3 years as well, we've seen more and more activity on secondary transactions, secondary markets, which means that a lot of the liquidity that we don't have in the IPO market happens on, sort of private transactions where early Facebook, Twitter, Zynga employees have been able to sell a portion of their shares and get liquid in advance of a liquidity event. So the typical strain we would have in the system if ever there was no exit whatsoever has been relieved by that.
And I think there's also, a lot of discussion around so much more deal flow happening and this potential Series A crunch, which I think is actually not a Series A crunch. I think it's just a lot of late-stage VCs seeing about 5 times as more deals as they're used to, and probably that's a good thing for them. They can be more picky. They can see higher quality transactions to put money into. But I think in general, it's a very, very positive environment. The overall macro picture for startups, particularly consumer and small business services, is just fantastic. I mean, cost structure continues to go down, market size continues to increase, monetization and distribution platforms just continue to get better all over the world. You have devices like these that are bringing the young and old into the market. So I think there's a lot of very positive reasons for investors to be investing. Possibly the one thing that is worth a little bit of concern is just because there's so much enthusiasm and because you see these big public exits starting to kick in again, valuations are probably a little bit overheated. And all of us here probably wish that wasn't the case, but we're still probably investing twice as much as we were in the last few years.
And valuations at early and later stage?
I think across the board. I think the late stage investors think we're crazy, and we think the late stage investors are crazy.
But it's interesting. If you compare valuations in the public markets with those in the late stage private markets, the public companies are much cheaper. Or said another way, the private ones are very, very expensive.
Well, Yuri Milner would certainly agree with you on that one. I think that DST has made a killing arbitraging the perceived value of not quite public companies, particularly in tech.
If you look at the latest sort of Zynga finding and the fact that they're going public at a whatever $10 billion valuation, on paper the the mutual funds that bought on the private market some Zynga shares have lost 30% of their money on paper, which is pretty substantial because typically when your company sort of goes public, there is definitely a premium from whatever round that you did last, and so that could be sort of an issue.
What do you think, and having over various parts of my career being described as a banker of sorts, I poached a gamekeeper. When you look at these IPOs and you look at the process they've gone through and you look in the immediate aftermath of where they then trade, what are bankers, companies and investors doing wrong when you see such a decline in some of the share prices, when you see that spoiling the potential for some of the IPO pipeline that exists? Macro issues aside, there is something that we're not getting right, particularly in Europe and arguably in America to an extent as well, about making sure that the gradual increase in price, the institutions coming in getting a good deal, is not there. That it's being treated too much as an exit, some would say.
Yeah, but I don't fully agree. I mean, we're having the worst crisis since World War II, right? So of course, public market share prices aren't going to be so great. So I don't think the fact that some of these companies aren't trading where they used to trade has anything to do with what the companies did wrong or approaches of investors that weren't quite right. Face it, it's a very, very difficult world out there right now.
I agree with that, but this sector, historically in good and bad times, has been one that's renowned, and push back if you disagree. I think it's great if you think the IPO markets are going to be sustainable, but it's been renowned for hitting its peaks and for the public market institutions not to get it quite right and end up being stuck there, having come in at a too high a price. And the public company is actually arguably then suffering from a slightly sort of illiquid, poor-performing share price.
I think in some respects it's almost a mistake to lump everything that's the web into the same market. I mean, trying to compare, you know, a company like Groupon with a company like Zynga with a company like LinkedIn, they're vastly different. I mean, it's like saying, okay, well, what if I were to compare the public market prices of a casino, you know, and, you know, Walmart, right? They're not really the same. I think, you know, Zynga, the reason I think a lot of people were questioning Groupon was, you know, well, obviously the founders had taken a lot of money off the table early, and they were really pushing sales pretty aggressively. So there's a little bit of perceived, like, are the founders really in it? And also a perception of, you know, are those sales going to be there, or are they just pumping them up on a certain period of time? But still no question that business, you know, it's been generating billions of dollars in revenue in a very short period of time. Similarly, Zynga, you know, also has, you know, a billion-dollar business. I think the challenge there is can the company continue to produce hits on a regular basis? That business is definitely based on relatively short-lived games, and so having a studio approach to being able to build more and more of those is different. So I think the analysis is different for each of those companies, and you can't just lump everything because they involve servers and the web into a similar category and assess, you know, market perception as a result.
But John, what worries me is that the IPO market in the US is so-so, but in Europe it's virtually non-existing, right? So that's the real scary thing.
And in China as well.
And Eric.
I think one of the mistakes that we need to learn from what we call bubble, from what is really a bubble on the stock market for this type of, you know, early market companies. It's really a disconnect between the expectations of the investors and the people that are floating those companies. And it's really when Wall Street or the London Stock Exchange becomes a venture capitalist. Because at some point, the institutional investors hate surprises, and they hate surprises not because they don't like surprises, but because of the model they have to run through. You know, a lot of people have to look at payouts for pension funds and stuff like that. And this is really serious. You know, you have actually pensioners that are, you know, waiting for the checks. They cannot miss that. So their views of what a stock should be and what, you know, the expectation of the movements in the stock market and so on are very different from a early stage company, still early stage company, even if it's generating billions, which has to really work on its infrastructure to come up with, you know, managing outcomes. And I've been in the past, I won't tell you which companies, but I've been in the past on companies that we took public. I was on the board of the company. And then you look at the actual infrastructure of the company, the finance, the reporting, the controlling, the product management, and so on. And you look at how much you need to quickly backfill to have this company, you know, resemble a very predictable engine that comes up with things which are very predictable. It is an issue when you get companies, regardless of how exciting they are, how much revenues they are generating at some point, becoming a, you know, really predictable engine. That's why a great company like Facebook is not hurrying up to go public.
Yeah. I think Dave mentioned it. The thing with Groupon and Zynga is that 3 years ago they were barely starting, and so we've never seen companies get to such scale and footprint in such a short time, just because of social viral, you know, distribution techniques and so on and so forth. And so the public market is just not used to see those behemoths arrive on their doorstep after just a few quarters of data that they can actually analyze. And so
they're really ready
that's
you know, from an infrastructure point of view, from human people. You know.
But at the same time, it's not because they get there so much faster that they shouldn't actually seek the public market if they believe that this is something worthy of doing.
And I think in mobile we have yet to see that. So social and local have seen businesses that are growing phenomenally. There are a number of mobile businesses being built that will take advantage of some trends that are very, very powerful and that will grow as fast, maybe not even faster than those companies, which is the exciting part for us here all in the room, because there's really exciting opportunities. For example, in mobile, there's like 700 million smartphones out there now. In a matter of 3-4 years, that will be 3 times as much, which means that there's an enormous platform for new applications that's available and that's growing at unprecedented rates, which will create really, really interesting businesses and business opportunities.
I also think that those are going to different places than they have been before. We were talking about sort of like returns, and I think while there's still a majority of capital being invested, probably in the US and in Silicon Valley, the majority of the returns right now are happening in Asia, particularly in China and India. So as the mobile trends accelerate, you're seeing like ridiculously large growth. I think China's already the largest mobile phone market by far, but probably also one of the largest, if not already, smartphone markets by far. And in India, I think you've had like literally growth of like 500 million users in India, maybe still on feature phone platforms in a lot of cases, but just like dramatic growth in those markets. So we're starting to shift a pretty significant percentage of our investment to international. Historically, it's been about 10%. I would say now about 25% is international. And places like Brazil and Russia and Southeast Asia are definitely coming up in priority.
Do you think with some of those markets and the shift and the growth characteristics of some of these businesses, the length of investment is likely to increase in terms of the time? We were talking earlier about 6 years average on a big sort of M&A exit, 9 years on a big IPO. Can you see over the next 10 years that lengthening, changing in profile in any way?
No, I mean, I don't. And actually, I think people talk about that 6-year time frame, and I think that's bullshit, because actually a lot of those companies already had liquidity events. So you're seeing companies like DST come in and do large equity financing, second markets like doing financing. So a lot of those companies might have been liquid effectively 2 years prior to IPO. You also have the majority of our investments, at the very least, I don't know about the other panelists who are larger, are getting exits because of M&A, not because of IPO. So I mean, we watch the IPO market for overall liquidity trends, then that impacts the industry. But I would say our average investment median to liquidity is probably 3 years. And in fact, we've had 10 exits. We started investing about 1.5 years ago. We have 10 exits. We have 2 that will probably close before the end of the year. Obviously, those are on the smaller side of it, but I think the arc of time frame for liquidity for us is probably 1 to 5 years, not the typical 6-7 year thing that's being quoted.
I think it's going to decrease. I think we're due for a cycle where there's going to be a number of very good exits. I think that will be roughly 2012, 13, 14. Which means that the cycles will shorten already. And in addition to that, these businesses are growing much, much faster than they were in the past. I mean, Groupon was the world's fastest growing business ever. And I think that's going to continue. I think there will be mobile businesses that will grow even faster than Groupon and Zynga. So the time from nothing to massive businesses is shortening all the time.
The curve starts going like this instead of like this now. I think that's why you're seeing these big firms that are raising lots of capital and throwing money. Like, Uber just raised 30 million, and like the business didn't exist 2 years ago. So I think you're seeing, because of the cost structure for doing, lean startup types of experiments and a lot of smaller deals, you really don't have to spend very much money in the early cycle of the business. A lot of those might fail, but the ones that actually do succeed and start ramping up the distribution curve, then you can actually shove a lot more money into those deals and actually go try and clear out the market. So I think the shape of those curves look a lot more, asymptotic than they ever did before. And sometimes I think that's a crazy thing, trying to figure out where on that curve is the valuation lie. It's a little weird when you have a company like Dropbox that's being valued at $3-4 billion that was worth, I don't know, 5 million or less a couple of years ago.
But it's because there's massive trends that we can all take advantage from in terms of building businesses and financing them. And it is trends that are bigger than they have been in the past.
No, I think anecdotally, I'd say at the smaller end of the market, we're certainly seeing an increase in levels of M&A. I think people are doing more M&A and considering more M&A quietly. They're not having big open processes. I think we're seeing a lot more sort of US corporate cash coming over. It can't be repatriated into the States, so that we're certainly seeing a lot more US corporates now trying to look at European M&A and being more international. I think that's here to stay. Eric, I don't know whether you would agree with that, but there's certainly the level of M&A in our view is actually building a little bit.
Right, but again, I don't want to sound, like looking at the past all the time. If I look at the history, for the institutional investors, things have been, the returns have been really generated by these big IPOs over the past 30 years. 90% of the returns have been generated by 2% of the deals, the big IPOs, for the institutions. So you really have two ecosystems. You have the large amount of money being poured into the largest share of the capital being poured in the venture capital industry is from institutions. And those institutions are getting their money back and returns mostly from these big IPOs. Historically, there's always been a lot of M&A in between, and that's where the early stage investors, the seed investors, the business angels make money. But for the industry to survive, they need these big IPOs. Otherwise, it doesn't work for the institutions.
I wanted to add also that I can see sort of Chinese and Japanese companies being much more active, even in the US, especially in the gaming sector. And so when we see the balance sheet of companies like Greed, DNA, or Tencent, they certainly have several $billion they can actually invest in acquiring US assets to build up their own footprint. And so, it's certainly something that we see day in, day out.
Quickly wrapping up, just go through all of you. Looking forward to next year, various regime changes have occurred. Hopefully the Eurozone gets itself sorted out. Where is your focus going to be? What excites you most about the year looking forward in terms of both geographic and sectoral focus? Or maybe you're taking a year off, I don't know, Harry, but where's your focus going to be?
Mobile and emerging economies. We're doing a lot of work in Russia these days. We're doing a lot of work in Brazil as well. So the three areas that we mentioned, mobile, social, local, plus new emerging economies.
Dave.
I think, so we're spending a lot of time looking at subscription verticals in commerce. We've already done several companies there. So coffee company out of New York, a company called Manpacks out of Canada that sells socks, underwear, and condoms, and a company called Kiwi Crates that's run by a former PayPal colleague of mine that's doing arts and crafts for kids. I think those models are just really straightforward to go after. Take any magazine on a shelf and you can turn that into a subscription vertical commerce business with very predictable revenue. And actually, surprisingly, not as much competition outside of, I would say, China and maybe Germany, where those models are being practiced pretty regular. The other area I think we're spending a lot of time is, again, I think children's books and sort of consumer education, particularly iPad, I think are just like awesome markets. Historically, education's been a really painful market to go into because usually it's determined by state regulations, at least in the US. Now you can go direct to the consumer, and surprisingly, I think because a lot of entrepreneurs are single and male, that hasn't been looked at as a very interesting market by most entrepreneurs, but it's huge. It monetizes extremely well. I think Jeff and I both have kids, and so we pay more attention to that. I'd easily pay money for the Netflix equivalent for a storybook device here. Having physical books on my shelf, for the kids is just like stupid. And these devices are great for education. They're great for games if you are okay with giving your kids games. But I think we're just going to see an explosion of those types of businesses. Geographically, we're spending a lot more time in Brazil. We hired a person who's a Brazil native. I'm taking a group of folks to India literally right after LeWeb, and definitely going to be probably doing more in India. We've already had some investments in Japan and China. There's a little bit more challenging doing those. And then just starting to learn more about Russia, I think there's really tremendous opportunities there too.
Yeah.
So for us, in terms of geography, it won't change. It's really sort of US focused. And actually, when I say US, it's really Silicon Valley in New York. In terms of sectors, talked about next-gen e-commerce, talked about disruptive vertical SaaS. But I would say that overall, like Harry, we're super excited about the opportunity to build the mobile equivalent of successful web services, which will be reinvented because the form factor is different, because the access is different. And so I can see about 50 to 60% of our Fund 3 to have a mobile flavor.
And finally, Eric.
Well, cannot agree more with the comments on the type of businesses. Although, quite frankly, every year I think about what's going to happen next year in terms of the type of companies that will show up. And the great news is we're always surprised by the creativity of the entrepreneurs. So I think these guys know much better than I do what the next big companies are going to be. In terms of geography, we are European focused. So we have a lot of time in Berlin. I think Berlin is really happening right now in Europe. That's really the place. If I were 25, I would go there, and it's amazing. Stockholm is also very very brilliant, and London. And as I said, we'd like to spend a bit more time in Paris, but we haven't found the time yet. So.
Thank you very much. Gentlemen, it's fascinating that we're all saying the same thing, which is that the capital is there, entrepreneurialism is alive and well, despite what's going on around us, and you will remain very excited about where you're going to be investing over the coming years. Thank you very much.
Thank you, guys. I know this is frustrating. We would have gone for a much longer time, but that's LeWeb. Thank you so much.